approaches, 8:30. Call to order the May meeting of the Federated City Employees Retirement System and Healthcare Trust. Begin with a roll call. Vice Chair Faulkner.
Here.
Trustee Abbott.
Here.
Trustee Chandra.
Here.
Trustee Chi.
Here.
Trustee Linder.
Here.
Trustee Nakagawa.
Here.
Chair is here. We are all present. That is great.
A record.
Possibly.
All present.
Orders of the day, we have none. Wave sunshine, we have none. We don't need to qualify any remote trustees, so we can proceed with the agenda. We have no closed session items. At this time, we will take public comment, general comment on items that are not on the agenda for this meeting, but are subject matters that is under the jurisdiction of the board. Speakers will have 2 minutes to address the board. And are there anyone here who wishes to speak, or anybody online? We do have a commenter. Can we please introduce the commenter and begin the clock?
Chair Horowitz, we have Brad. Brad, you will have 2 minutes. When the timer goes off, you will be muted.
Commenter, please proceed.
Good morning, trustees. Thank you, Cynthia. And hey, I just wanted to comment, with all the talk about AI, has there been any serious discussion with regard to how AI is going to be used with managing our pension funds? I imagine I don't imagine, but I assume that the consultant, and I believe is it Makita? Do you still have Makita? Is using AI for a lot of their reports. Maybe we need to use AI to make our investment decisions, and I don't know why you would need a chief investment officer when probably most of those decisions are being made by AI anyway. So, and again, I assume by your silence you agree with me. So, correct me if I'm wrong, Mr. Flynn. You know, back east there's a large pension fund. I think it's about $300 billion, and they're managed by one trustee. And I believe it's the New York. I don't know. You probably know that. You could kind of refresh my memory on that. So you know, they can manage their fund quite nicely with one trustee. So, but I know that's probably not the model that most pension funds are using now. They have a board like we have a board now. We probably, unfortunately, expanded it to 7, and I don't know how much extra added alpha that added to the fund. And you know, I noticed going down the agenda, I noticed the list of the death notifications has increased. It seems to increase almost every month. So was it the strategy of the board to increase the funding status by
That is time. Okay, I'm not quite sure where that last thread of comment was going, but I believe the number of deaths have maintained themselves over the years. They vary by month. And we will be touching on AI, I believe, later in the agenda. Under education?
I mean, it's AI's general topic across all areas of the fund, not just investments, but.
Okay. It is certainly something we are looking at and focused on. With that, we will move to the consent calendar. It's been a month. Do we need a motion for a consent calendar?
Yes.
Do we hear a motion to accept the consent calendar?
So moved, Mr. Chair.
Thank you, Trustee Linder. Is there a second? Trustee Abbott, is there any further discussion? Any public comment? Seeing none, we can all vote by raising hands as we're all here. Okay. I'm sorry, was there a comment on the consent? No. Okay, very good. Moving forward then to death and survivorship. We will now have a moment of silence for those who have passed and who have served the city and who have passed. Okay, thank you. Agenda item 3A, oral update from our CIO. And as I was absent for your first meeting as a CIO to the board, let me add my welcome to our new CIO, Mr. Kwan.
Thank you so much.
And looking forward to your report now.
Thank you, and welcome back. So we've got two pretty important items on the investment agenda today. These are the private markets pacing plan, and as well as updated risk and return expectations for the strategic asset allocation. So these are two pretty forward-looking presentations, right? The pacing plan is intended to give you, you being the trustees, a sense of the private fund commitments that the team will be making in the next fiscal year. And the strategic asset allocation update will give you a sense of how the market expectations have changed for our asset class weightings. Both presentations were approved by the IC back in April. And so I'm looking forward to how the full board receives them. And before we get started with that, as is customary, we have performance estimates provided by Makita. So for this will be through the 19th, Tuesday. For the pension, we have an estimate of 11.54%. And for the healthcare trust, 15.4%. So you'll note that both numbers, again, I'll just remind you that they're estimates, but both numbers are a healthy margin above the discount rate for either pool of capital. So, knock on wood or save your rabbit's foot or whatever it is you want to do, but we're getting there. If there's no questions, I'll turn it over to the private markets team for the pacing plan.
Are there in fact any questions from trustees? All right, they're very encouraging numbers. Any public comment on this agenda item? There is a public comment. Again, public comment on agenda items are limited to 2 minutes. If staff can announce the commenter and let them proceed.
We have Brad. Brad, you will have 2 minutes. When the timer goes off, you will be muted.
Okay, before I was cut off, but I won't continue that comment, but I'll wait until we get to that item. I think it's item number 2. Anyway, with regard to my initial comments, so how much of the investment report was generated through AI, and why can't the investment reports be generated by AI? You don't need a person to do that. So, yeah, I think you need to seriously look into that. And in terms of your manager selections, that could all be done by AI much more efficiently than a board could do that. And anyway, the board doesn't make investment decisions. I stand corrected. You hired this $400,000 a year chief investment officer to make all the investment decisions for the board. So I'm really wondering what you're all sitting there for. So, thank you. You didn't have to cut me off this time.
Okay, thank you. Again, we are certainly interested in AI. I think it's far from proven that they would be a superior investment manager. So I don't think we want to be on the bleeding edge of that discovery process. 3B, discussion and action on private markets pacing plan. Dinesh, Acting Deputy Chief Investment Officer, and David Allen. We have a presentation.
Yes, we do. Good morning, everyone.
Good morning.
Today we'll be presenting our annual private markets pacing plan. As Jay mentioned earlier, this was presented and approved by the investment committee with a long discussion as well. And let me start with the purpose of this pacing plan. So private markets are different than public markets in that we can't buy and sell as we can in stocks and bonds, so we can't directly get to our strategic asset allocation targets. Instead, in private markets, we're making commitments to private fund managers who go out and make investments and call capital after they've made those investments. And when they realize those investments, they return the capital back to us and distribute it back. So what the pacing plan does is it models out where we are currently and how much we have in the ground, how much commitments that we have that are unfunded, that managers are going out and seeking new investments, as well as how much needs to be committed on an annual basis to get to the strategic asset allocation targets and remain there over time. So today we're going to be showing you pacing plan modeling that's completed by our partners, Neuberger Berman for the buyout asset class, and Makita Investment Group for the 4 other asset classes. We're going to show projections 10 years out, but we revisit this and recalibrate the model on an annual basis to look at where we actually are and how much needs to be committed for the upcoming year. The year-over-year changes are usually minimal, and that's what you'll find again today. So I'll walk through a summary of where we are today, and then David's going to go through some of the pacing plan modeling building blocks. So first, looking back at history of how our private markets allocation has evolved over time. If you look at the far left of this page over the last 7 years, we started out with a very low allocation relative to target, 11% back in 2019 relative to a 25% target. There was very low deployment in private markets following the GFC. However, starting in 2017, we have a dedicated private markets team. We built out our resources and created a consistent process that we've been following since that point. And we've, to this point, gotten to 22% of plan relative to the 21% target that we have for private markets. So slightly over-allocated as a result of a change in asset allocation in 2020, and also the strong performance of the investments that we've made to date so far. A common theme in the market today for private markets is the lack of distributions, or DPI. What you'll find on this page is we're showing the last almost 5 years of data for capital calls and capital that's being put to work for new investments on the left-hand side of the page, as well as the distributions and capital being returned back to us on the right-hand side of the page. So the distributions, especially in 2024 and even so far in 2025, have been quite strong. One asset class in particular that stands out is the private real assets, which is the red bar at the top of the page. And in 2024 and 2025, it's done very well, even though it's one of our newer asset classes. And that's asset class that's continuing to call capital but hasn't gone to the maturity to distribute capital yet is venture capital. So on the left-hand side of the page, those purple vertical bars show venture capital dollars that are being put to work. Looking back at the current fiscal year, we expect to have completed $136 million of commitments. That's 5% more than the pacing plan. And I mentioned the pacing plan is just a guide. It's not an actually set in stone amount that we must deploy on any year. This is a bit unique compared to other public pension plans that have more of a use it or lose it approach to the pacing plans. They have to either use their full amount or that's the maximum they can do. And if they don't use it, it doesn't roll over into future years. The investment policy statement that we operate under gives us more flexibility, more similar to an endowment or foundation, where we can go up to 150% of the pacing plan plus the previous year's under commitments. So looking at the 5 asset classes that we have, 4 of them are either at or above the target for the current fiscal year. There is one that's below, which is growth real estate. And this is the 4th straight year that we've actually been below the pacing plan target. And this is intentional. A bit of a different place that we're at today versus a year ago, where we feel like the real estate market and valuations are quite reasonable. However, private funds have experienced fundraising challenges where usually they would be able to raise a fund in 6 to 12 months. Now it's taking, in some cases, upwards of 2 years. So we've shifted our stance towards being a later close investor instead of coming in earlier. So we're able to backfill vintages, be able to underwrite existing portfolios, make sure no surprises happened at a firm or organization during that 2-year or so fundraising process. And also gives us a chance to come in at cost on investments that were made a year or 2 years ago, which may be off to a very good start. One of the common questions we get is to quantify how well we're doing. And first, we're going to show on this page how we're doing relative to public pensions. So using data similar to how the quarterly performance reports benchmarks the entire plan relative to public pensions greater than $1 billion, this is using data from investment metrics sourced through Makita. And looking at each of the individual asset classes, the results are quite strong, all in the top quartile, and in the cases of growth real estate and private real assets in the top decile. So strong performance relative to public pensions. We've also gotten this metric added to the quarterly performance report, so you'll start to see this going forward. And secondly, if we look at a broader universe of all the private funds that exist, not just the ones that public pensions have invested in, this includes a universe that has $13 trillion of private funds. When we look at the vintage years 2017 to 2025, so the ones done under the current team and under the current process, you'll see top quartile results in private debt and private real assets, and above median results in the second quartile for buyout and growth real estate. And if we quantify it relative to the median private fund over this 5-year period, we've made $150 million of alpha above and beyond the median fund. We also are very conscious of fees and looking to make fee savings wherever possible. I mentioned in the case of growth real estate, which also applies to other asset classes, that fundraising has been challenged. Some private fund managers are offering meager to no discounts for being an early close investor. So in some cases, we're giving up some fee saving in order to get a better net return by being a later close investor. But at the same time, we're making that balancing act of negotiating the best possible fees we can. And in the calendar year 2025, we were able to achieve $4.3 million of fee savings, about half through the use of co-investments within the buyout asset class, and about half through our own negotiations with fund managers for fund commitments that we've made. Now I'll pass it to David to go through the pacing plan modeling.
Thanks, Nish. So in the next couple of slides, we're going to give you a brief overview of some of the inputs that go into the pacing plan model to come out with the output and the eventual ask we have of this board. So on a high level, the pacing plan modeling incorporates three kind of basic, three kind of factors, I guess. One is asset size, two is assumed returns, and three is cash flows. So on page 10, this is the first of those building blocks, which is asset size, which on a yearly basis is kind of reset at the current asset base. So you can see as of 6/30, that's what it is. And we also display the difference between the asset base of this year and last year. The forecasts incorporate Makita's 10-year forecast for all our assets, as well as the actuarial cash flows projected by our actuary. And you can see the difference is a little higher, pretty minimal, not really enough to move the pacing plan much. On the next page, it's a table of our unfunded commitments. So this goes to the one of the other components in terms of cash flows. So unfunded commitments represent, essentially commitments that we've made but have not yet funded. So you can kind of think of it as a little bit of a unfunded or a liability, I guess, in terms of money that's could potentially be called and deployed. And so the the next page shows the difference between this year and last year's pacing plan in terms of in terms of the dollars to be deployed. This is a difference. And so the biggest thing that pops out is the buyout line, calling for about 25 million less in year 1 and year 5, and negative 50 in year 2. And this is primarily driven by, again, the cash flow component of the modeling. I think with all the challenges in the buyout industry with DPI, the assumptions in terms of speed of distribution and speed of commitment has resulted in less requirement for deployment to kind of reach our long-term targets. And on the next page is just a visual representation of what the pacing plan aims to achieve. You can see each bar represents kind of the forecast for every year for the next 10 years, and the colored bar shows the various asset classes within private markets. And what you can see is that the model is forecasting that we are right around kind of target for the next 10 years. And finally, on page 14, it's the output of the model, our ask for today. The box, the red box, it shows the pacing plan for this year, and this is what we are asking approval from the board for today. And that's it.
Okay, are there questions from trustees? Thank you for the presentation. I have a couple of questions. We go back to number 13, slide 13. And if you could explain a bit more about what the proxy portion is meant to represent.
Sure. So the proxy, which is the purple bar that begins in June 2027, is any under commitments or any under allocation that we have in the asset class towards private markets will be allocated towards a proxy. And in the past, this plan was under allocated and used the Russell 3000 as a proxy for plugging that gap between where there's less actual exposure in private markets versus the target itself.
And you said in the past, where do we invest the proxy now?
There is no proxy since we're slightly above target. So
Okay.
if we look back at the history of our allocations, prior to 2022, that's when we had the Russell 3000 proxy. That was that in between the dotted line and the solid line. Once we got above target, starting in 2022, that proxy was liquidated and no longer invested.
But you're forecasting the proxy will return in the coming fiscal years.
Yes, so because
we're
of
going to
the,
dip below the blue line, as it were.
yes, there is an expectation to dip below the blue line slightly and eventually get back to target. That's one of the, I think, intricacies of this model. It's hard to exactly and precisely predict when it can get each of these asset classes to model to target. It's doing its best job to, over the long term, be as close as possible, but you're absolutely right that there are a few years, particularly 2029 and 2030, that the model shows that there will be some under allocation as the allocations go through this process of bringing these asset classes that are overweight, such as the buyout asset class, closer to target, and others that are underweight, such as the venture capital asset class, which is our newest strategic asset allocation, closer and closer to its target.
And just to confirm, if the proxy reappears in coming years, we intend to invest that in the Russell 3000 in the years that we have this underinvestment.
So I think that's where there's actually some flexibility. The police and fire sister plan has used a combination of both the Russell 3000 plus cash equivalents, so T-bills, so roughly a 50-50 split between those. So I would expect potentially for this plan as well to look for that kind of mix of those two specific assets.
Okay. And just another point of clarification, you mentioned that you have leeway under our current documents to go up to 150% of allocation, as well as rolling over the under allocation from one previous year, or is it all previous years?
So it's actually just one fiscal year that can be rolled
Okay.
over, and in this case, growth real estate is the only one that has that rollover. So the maximum commitments would be $230 million, which is 1.5 times the 145 million plus the 13 million of
Okay.
growth real estate under commitments.
And those rollovers and over allocations, they go by individual private asset class,
That's correct, yeah.
not as an aggregate. Okay. Okay, any other questions from trustees? Any public questions or comment? There is. Cynthia, if you will introduce.
We have,
Hello?
we have Brad. Brad, you will have 2 minutes. When the timer goes off, you will be muted.
Okay, sorry about that, because your audio's cutting off. Anyway, it's interesting, so I hope all the trustees understood that report by Makita. So anyway, getting into the fees, which was mentioned, so are we going to see a lowering of the fees as we move more and more to the AI model? So anyway, I hope you, the trustees will consider that there should be an overall lowering of the fees as we move into more and more into the AI modeling. Thank you.
Okay, thank you. Any other public comment? No other further comment? Any other trustee questions or comments? And if not, if someone would like to formulate a motion to accept the pacing plan as presented? We have a motion from trustee Abbott. Do we have a second?
I'll second.
We have a second from trustee Chandra. Any further trustee discussion on the question? Seeing none, we can vote. All those in favor of the motion? All opposed? Motion passes. Thank you very much.
Thank you.
Thank you.
And now we're on to 3C, discussion action on strategic asset allocation.
Hello and good morning, everyone.
Good morning.
I'm going to go ahead and walk through Makita's report on our 2026 capital market expectations, and then I'll talk about the implications for your portfolio at the end. But give me a quick moment to pull up the presentation.
Okay.
All right. Looks like we're good to go. Every year, Makita puts together capital market expectations looking at major asset classes and trying to forecast long-term expected returns as well as standard deviations and correlations between the assets. We have a research team that's dedicated to this that does it every year using year-end data from the previous year. So this year we'll look at data on asset classes through the end of 2025. Themes that happened in the market that year and previous years will tend to slightly change what our expectations are year to year. So we have a team that's been doing this for decades and decades, and they came out with their expectations for this year, and so that's what I'm gonna go through at the moment. We'll put these together with the understanding that expected returns are not going to come down to the decimal. We don't think we're going to get them right over 10 or 20 years, but they're a good measure of where we think things will land in 20 or 10 years. Another useful thing to look at with these is how asset classes now stack up compared to each other. So where does the expected return on investment grade bonds compare to public equities, and how has that changed over time? And so that's another important measure that we look at when we do these. We put together numbers over both 10 and 20 years. For a pension fund like this, we tend to focus on the 20-year period, given just the long-term nature of the fund in general. One thing that's nice that Makita does is we try to stay strictly academic. We take data from things like the IMF and the World Bank. We don't sell any products, and so we try not to have any biases for shifting clients to certain asset classes over another because we don't have incentive to do so. So we try and keep this process as objective as possible. And that's nice for someone like me, just, when we come to talk to funds like you all, it's nice to be able to rely on that. Going into this year's expectations, there were two key themes in markets last year that drove a lot of what we're seeing the changes we're seeing year over year. The first one being valuations within public stocks continued to push up. So you saw a big run up in stocks within the US, but also particularly internationally in international and emerging markets. And so that pushed up valuations, which tends to bring longer term expected returns down. And so you saw that theme when I go through asset classes in a moment. Expected returns for public stocks have come down this year. Another big change is interest rates. Those have an impact on many asset classes, including particularly fixed income. Interest rates came down, and expectations for future interest rates came down over the course of 2025. And so it was modestly, but enough to change the forward-looking expectations for most of those asset classes. And so you're seeing a decrease in expected returns from the decrease in interest rates. Those are the two key themes. Most of our clients, most institutional investors saw about a 50 basis point decrease in their total fund expected return over 20 years. That's consistent with what we're seeing for the Federated pension system. Last year, the expected return over 20 years was 8.6. This year, that came down based on our new expectations to 8.1. Standard deviation stayed somewhat the same, but increased about 50 basis points, and that's measured by Verus and Cerity. Based on what we're seeing with our expectations this year, we don't recommend any changes at this time. It's an important exercise to look at capital market expectations and what the implications are, but we don't see anything in this data that would prompt us to recommend a change. The expected return of 8.1 is still well above the discount rate, as you all know. Jumping to the next page, I'll talk about specific asset classes and what their expected returns are. So if you can see on this page, we pulled out major asset classes and the expected return over both 10 and 20-year periods. And then the columns that are colored show the increase or decrease compared to the previous year. As I mentioned, two major factors that drove the decrease in expected returns for these asset classes over both time periods are that increase in valuations on the equity side and then the decrease in interest rates on the fixed income side. And so that's driving a lot of these results. If you go down the line, you can see most asset classes came down modestly. I'll point out that things like developed international stocks as well as emerging markets, they came down more than what you're seeing on the US side, and that's because of the bigger run-up in those valuations and those returns last year. Another thing I'll point out here is real estate and infrastructure. There, over the 10-year periods, those are the only two asset classes that had a modest increase. Those asset classes rely on a lot of leverage, and so the lower interest rate environment actually was helpful for those over their 10-year forecast. Two other things I'll point out here is it's important to look at the relative differences between asset classes. For a long time, the difference between the return you're getting from things like investment grade bonds and equities was a big difference. That's come up in recent years, and so you can see investment grade bonds over 20 years is giving you 4.9%. That's a lot of the way to your discount rate right there just from bonds, and so that's interesting to look at the split between those asset classes. I'll also point out that if you look at public assets versus private, we're still seeing a premium for private assets. So if you compare private equity to public equity counterparts there, you're seeing a premium for those private asset classes as well. Two other things to point out here is that when we talk about the public markets projected returns, these are gross of fees, but they're net of alpha. And so in many asset classes, we think active managers can produce alpha above and beyond what we're showing here because we're just modeling what we think what the passive option would do. Within private markets, where fees are a much bigger component of returns, we do net out the fees. And so within private markets assets here, you're getting a haircut for the fee already on here. The next few pages are pages that maybe many of you all have seen before, but it just sort of sets up how we do our process annually. So I'll jump to two more pages here. We start by building 10-year forecasts first. For major asset classes, we use finance theory. You can see the different components here for each asset class that go into building those forecasts. Some have a bigger emphasis than others on that ultimate number, but these are some of the major components that go into it. On the next page, bonds. The yield is very helpful for predicting returns and has proven to be very close to what the bonds will return over the long term, and so we use yield to worst for those asset classes as a predictor. For equities, there's a few more components. So we look at a dividend yield, expected earnings growth, a valuation impact, and then if it's an international, a currency effect. In the past, the currency effect has proven difficult to predict, and so we've actually de-emphasized that in more recent models to sort of minimize that impact. The next page shows sort of how some of these components wrap into our ultimate 10-year expected returns, and sort of like proportionally, what proportion each component will make up of that expected return. Finally, we move from a 10-year return to a 20-year return. For the 20-year return, we use a slightly different risk premium approach, and so that's taken a historic risk premium for each asset class over a risk-free rate. And so we take that for each asset class and then combine that with what we've done over the 10-year to get a 20-year longer-term period return. And then the final step is we have an investment committee, which Laura Wyrick, who I believe is on the call, is actually on that committee. And we look at the raw quantitative output for each asset class annually and sort of play devil's advocate and see if there's any qualitative updates that need to be made that sort of just make sense with where our committee's head is at. And so that's sort of the last step before these get published. A few more slides I'll point out. I already talked about some of the major changes from the previous year, and here I mentioned lower yields was a big component. You saw that yields across the board came down. Here are major index yields between last year and this year, and they came down across the board for different components here. That was a major driver. I already mentioned slightly before on the equity side, but valuations, which are a big component, as you saw, of the equity forecasts, those continue to push higher, particularly for international assets. If you look at the two charts on the bottom of the page here, both PE ratios for developed international and emerging markets equities are now above their historical median. Similarly, for private markets assets, on the left-hand side for private equity, you can see EBITDA multiples. That's a measure of valuations. Those have continued to push higher over the past 10 years. And so that's been a damper on longer-term returns for the expected returns for those asset classes. I'll jump a handful of slides here, and I talked about for a sample institutional investor, we put together a sample asset class based on many of our clients here, just to sort of have a baseline. And that came down, the expected return came down on that model portfolio about 50 basis points based on this study. It doesn't tend to change much year to year if you look back historically. 50 basis points is sort of right in the middle of the changes that we typically see year to year, some years having more than others. But that's sort of right in the middle with what we've seen change historically. These don't change much year to year, and so we often don't suggest major changes to asset allocation policy based on a single year's predictions. Since 2000, CMEs generally have come down. As you can see from major asset classes here, you saw a little bit of a spike in 2022, 2023 when interest rates went up, but generally expected returns since 2000 have come down. Looking back between 2026 and 10 years ago, 2016 though, the efficient frontier looks better. And so that green line shows the efficient frontier, so the expected return you get for the same amount of risk for these asset classes looks better now than it did 10 years ago. Finally, we try to look at our track record, and so we've been doing this for a while, but not a super long period, and so it's difficult to get the data to look at what actually happened compared to what we predicted, because these are long time periods, but we try to do so on this page, and so you can see for each asset class, the green line is our forecasted 20-year expected return, the blue line is the actual 10-year return, and the orange line is the actual 20-year return for each asset class. So you can see some of them, especially for things like fixed income, are closer than others. We've done a decent job of predicting these over these time periods, but as I mentioned, we don't expect that our expected returns will exactly come to fruition. Some asset classes have been closer than others. High yield bonds, for instance, was very close over this time period, not as close for other asset classes. On the next page, you can see the track record for equities. It's harder to predict equities. There's a few more components there. We've done a decent job generally, but there's some variations that we've seen historically. U.S. equity, for instance, our forecast was much lower than what actually happened. On the international side, our forecast was a bit higher than what actually happened over these time periods.
I have a question.
Sure.
Why does it show a 10-year period up to 2016? Why not more recent?
Yeah, it's because it's a look back, and so we have to we have to cut it off based on we're looking back 10 years and 20 years. So we're looking at, for instance, in 2010, that number, whatever number it is, maybe 5%, that's the 10-year return forward looking from 2010. So that goes from 2010 through 2020.
That makes sense.
And so we had to cut the chart off in order to do that. And like I said, the data is all forward looking, but from backward period. And so it's difficult to sort of put these track records in place because of that. I'll go ahead and wrap up here on these next few pages. We do compare these to peers. There's a group called Horizon that every year pulls consultants and asset managers, brings together their expected returns and sort of pulls out, makes a median of that group. That comes out generally on a lag, and so we haven't seen what it looks like for 2026 yet. But on the next page, you can see what our results were compared to this Horizon survey for 2025. We use this generally just as a way to sort of benchmark what we're doing to make sure we don't have any outliers and kind of tweak our process going forward. Typically, there's not any one asset class that's typically above or below. It just kind of falls differently every year, but we don't see any major trends of being above or below the median. It's just something we compare annually. So finally, I'll wrap up on page 25, and this is the implication for the Federated Retirement Systems portfolio. I mentioned the expected returns from last year compared to this year came down 50 basis points, and so the expected return for 2026 over 20 years is 8.1%. That's still well above the discount rate, and we're not recommending any changes to the underlying asset targets. But that brings me to my second point here. If you look at the asset group targets, that hasn't changed from last year, but we do recommend one change in categorization, and so there's a new line there called multi-sector bonds at the bottom of the growth bucket. And so what that is a combination of what used to be siloed targets to high yield, emerging market debt, and investment grade bonds. And so those are now into one catch-all allocation at 11%. And so the underlying assumptions for the expected returns didn't change, but we're recategorizing that. And so that came out of discussions and a recommendation from staff, which we agree with. This is a sort of a trend that we're seeing with other clients and in the industry generally within the bond markets, especially within credit. We're seeing managers, opportunistic managers that have the ability or a mandate to make investments across different markets within credit. And so there's managers out there that can decide if they want to take an issue as a high yield bond, a floating rate bank loan, an investment grade bond, et cetera. And so giving the managers sort of the discretion to make those decisions based on what they're seeing in the interest rate environment and otherwise, we think is an industry trend. And there's a lot of really good managers out there that I think could fit into this mandate. I will point out that I don't think there's any plan to make a change to the underlying investments right now, but this is just a sort of forward-looking recategorization to kind of give the flexibility within this asset class. So I do believe that is an action item. I know I went through a lot there, but I'll pause and take questions generally on this page or any of the other points that I've gone through.
Since we had some questions about AI,
Yeah.
this is a slightly different one, but I'm just wondering if you think about how disruptive AI is likely to be, was there thought built into your estimations about which types of investments would be most likely to be disrupted or impacted by AI?
It's a great question. I do think AI is built into a lot of what we do. I think if there's maybe assumptions around, for instance, like on the equity side, we use projections for economic growth. And so if there is projections on how sort of economic growth will change based on AI, that will get baked into those returns. But I don't know that there's a specific sort of projection that we could point out that shows, this is what AI is going to do. But I do think AI creeps into a lot of sort of what the different data points that roll into this.
Yeah, that's a good question and a good answer, Colin. Thank you for being so nimble there. I would kind of add by saying we look at AI from two different perspectives. So one, it's a very significant factor exposure in the portfolio. We've been talking about a concentrated equity market for a number of years now, largely AI driven. But now we're talking about AI in other asset classes as well. You think about all of the debt financing that's being required to fund all of that capital expenditure going on. So it is, from that perspective, it's a growing concentrated risk in the asset portfolio. The flip side is, Colin noted that it's a potential driver of extreme productivity, and that flows into everything from base rates all the way through the equity portfolio. You know, and we're talking about a number of venture investments as well. So, you know, it's potential on one side, and because of that potential, a concentrated risk on the other. So it's certainly a topic of discussion. I would say it's not a driver of strategic asset allocation in the sense that we're weighting one asset class versus another because of AI, but it is a concern, just like we talk about inflation, just like we talk about different macroeconomic conditions.
Yeah,
Thank you.
actually, I've been spending quite a bit of time on that topic, because I apply my trade in
Right.
startups and AI and see what's coming around the corner. I think, first of all, we do need to agendize as a board AI generally, not just for investments, but how ORS, the city has a policy, and I'm sure there'll be substantial overlap with them, but I also think we have to focus on AI and what's unique to us and the attributes of ORS. As far as investments go, we have to figure out how we're using it internally. It cannot make decisions yet. You still need a human in the loop.
You do.
It is also an opportunity in our portfolio, and not just investing directly in AI, but the way, say, a private credit manager might use AI to uncover arbitrage opportunities. And it is absolutely a threat to many of our private equity companies. So we do need to the staff needs to be focusing on it a little bit more, and sooner rather than later.
Great. Any other questions from trustees?
Yeah, I have one. So, I mean, I think these capital market expectations are from December 31st. How are you updating it, responding to changes in how the markets are reacting? I mean, I was looking at the fixed income information, and I know you have the treasuries moved down a bit, but I mean, in the last 2 weeks, they've kind of shot up. So how does that play into how we should be thinking about the capital market expectations?
Yeah, that's a great question, and one that comes up quite often. We only update these typically on an annual basis, as you noted, and so there are obviously going to be changes in the market and all these markets throughout the year, and so we don't typically update it sort of live. Historically, if there are major changes, we will issue an update. So historical examples would be COVID changed a lot of dynamics, and so we issued an updated capital market expectations at that time. The recession, a while back, we made major changes at that time, and so there are cases where we'll put out updated capital market expectations, but we don't do that every year. And you noted there are changes, but it's something that will usually just these are really long-term projections anyways, and so changes in underlying interest rates and other components do make a difference, but it's something that we typically will evaluate annually rather than making periodic changes throughout the year.
Okay, great. Any other questions?
One question.
Go ahead.
On slide 25, the one you have up, the probability you mentioned of achieving the target rate is over 20 years has gone down, right? 74.9 to 68.7. Is there kind of a point or a threshold where we should start to be concerned if that probability keeps going down?
Like I said earlier, I think the expected returns bounce around a good amount year to year, and so it did come down from this year, and it's come down periodically. But if you look back on the chart, and this isn't for your plan specifically, but if you look back here historically, it's kind of split about half between years that it's improved versus decreased. And so I think possibly if there's years and years of persistent decrease, maybe it's something to consider. But 68.7 I think was the percent chance of surpassing the discount rate, and that's pretty hefty. There's a pretty good margin there still. So it's a good question. It's something that we look at, but just based on how these expectations bounce around year to year, and the fact that there is a pretty big buffer already built in to where that expected return is, I don't think it's something that we're necessarily super concerned about right now.
All right, thank you.
Any other questions? I've got a couple. Following up on Trustee Nakagawa's question, in consulting with other plans, 68%, how does that compare with other plans? Are we at the top of the range, or are most plans above 50%, or what should we know about the universe of plans?
Yeah, from my experience, I think that's sort of right in there with other plans. I think these capital market expectations right now are on sort of the higher end of where they could have been, if you look back 10 years, and so every plan's sort of benefiting from that. I think a lot of the plans that I work with have expected returns over 10 and 20 years that are exceeding their discount rates, and so you're seeing many plans have that percentage definitely over 50%, maybe in the 60%. So I think this is sort of right in the middle with other peers that I've seen.
Okay. And the other thing I'm interested in is we've aggregated several fixed income categories into a single multi-sector bonds. And in doing so, we've mixed together bonds that were previously considered growth as opposed to low beta. And that seems to have changed our top-level growth versus low beta split from 75-25 to 81-19. So I'm wondering the rationale behind that, if it's obscuring our understanding of how much we are committed to growth. And also, since we have a single category that the staff has the ability to shift amongst, it seems like they have more leeway to shift our plan between growth and low beta assets. So explain to me, give me some clarity about why this decision was taken and what it means, how I might understand it.
That's a great question. So first, let me start by reassuring you and the rest of the trustees, as well as any potential managers that are listening into the call, there will be no changes, no immediate changes to the manager lineup or the benchmarks. And so, the nutrition label on the back of the package is going to be the same after this as it was before, right? The ingredients are exactly the same. All we're doing here is we're taking the existing allocations, that's emerging markets debt, high yield, and IG bonds, and we're just grouping it into one line. So that's the immediate change that's going on. The reason we're doing it is, as you noted, it gives staff a little bit more flexibility going forward. So potentially, and by potentially I mean maybe a year or two in the future, there could be a additional strategy or two added to this allocation that rotates between the different sectors. And so the commonality here is that they all have some form of credit involved, whether that's credit in emerging market countries, credit in kind of lower rated companies, or even IG credit. And so the credit landscape is ever evolving, and I would say recently evolving faster than it has been before. And so these companies, if you're a company looking to borrow, you have different avenues, and those avenues, representatives from those avenues are coming to you and they're pitching their products in different ways. They're competing on things like covenants, speed of execution, maybe other tie-ins to other potential forms of capital. Those pitches to those companies turn into commitments, right? And that reaches us in the form of one kind of financial product or another. And so as the opportunities, those companies have changes, as those forms of capital kind of compete against each other, it filters back to us in products with changing opportunity sets. And so just the same way that those companies have the option to choose between different forms of borrowing, we should have the different options available to us of where we want to invest the incremental dollar of capital. That's the whole idea behind creating this multi-sector, multi-asset, I haven't really come up with a name yet, bond allocation. It's just a little bit more flexibility at the staff level to rotate between different sectors that will have changing levels of opportunity. Again, no immediate changes to the manager. Nobody's being fired. No immediate changes to the manager lineup or from your perspective to the benchmarks that are being recommended that roll up into the strategic asset allocation.
What about Trustee or Chair Horowitz's question about sort of at least the optics of the rebalancing of an 81-11 portfolio now? And I know our volatility, in fact, we're still well below our policy volatility limit, but it's at least I've been doing this for 10 years. It's a little bit of adjustment for me to think about this now as a growth asset, and then like an omnibus category, as opposed to kind of getting the granular understanding of how each different asset class within it is performing.
Right. So I think you referred to it correctly. It's largely optics because exactly what was in it before this change is exactly what's going to be in it after this change. I think it may require a little bit of fuzzy logic, I suppose, to think about what was in there and think about whether that was actually growth before, whether it continues to be growth going forward. But again, the ingredients haven't changed. So in fact, the way it's being modeled is just the exact same way as it was modeled before. It's just a roll-up of the underlying components. We've used the functional asset labels for a decade plus now, and I think it has been helpful, essentially at the board level, to help you all categorize how much growth exposure we have versus kind of offsetting buckets. But at the end of the day, it comes down to the component pieces. And largely when we're thinking about the portfolio and changes over time, I tend to split it in terms of kind of stock bond mixes anyway. So 75, 25, 70, 30, those are the types of numbers that I would refer to. Even those are very broad categories, right? If you look at what goes into growth, we're spanning everything from stocks to bonds, certainly different levels of exposure to a underlying growth factor. So I'm not too concerned with, maybe you tell me, I'm not too concerned with your ability to kind of hold in your mind the idea that we're relabeling some of the components, given the fact that, again, nothing is actually changing. One of the labels was other, so I'm not sure how growth or non-growth that really is, but it is largely optics.
I'll concede multi-sector. It was always it was sat somewhere between growth and low beta, but I've always thought of it as a low beta portion of our portfolio, skewing more in that direction. But it's semantics. This old dog will try and learn some new tricks, I guess.
Yeah, I wouldn't overestimate my ability to hold multiple thoughts in my mind at the same time. I guess my only concern is we have aggregated, it's together, it's a larger allocation, 11%, and there are things that are clearly more volatile, high growth, such as high yield bonds, and things that have traditionally been relatively low volatility with investment grade. I understand there's a changing market in terms of credit and how the continuum between them is changing, but I think it does obscure something for us as trustees in terms of how we think about it. So let's continue the conversation about that, if we may. Maybe we need to pull out subcategories just so we understand, and to make sure we're not shifting from when we evaluate asset allocation in terms of changing it, the changes we make are fairly incremental. If we go from 75% growth to 80% growth, that's kind of a major change. And now that can happen all within that aggregated class of multi-sector bonds, kind of beneath the ken of trustees. So I think there's some issue there of our visibility into what's happening. I understand nothing has changed this year versus last year. My concern is what changes may take place in the future that may be slightly obscured by this. So.
That, I think, is a great point. I would point out that I'm not recommending any decrease in your authority here. to determine strategic asset allocation.
No, I understand that, but our understanding
our
of what we've
visibility.
authorized may be obscured, so.
Sure. And in terms of transparency, we're happy to provide any look-through that you desire. You know, we can do that at the IC, or if you want to bring that up at the board level, we can look through to the benchmarks that underlie each of these asset classes. But in terms of the additional flexibility given to staff by the aggregation into multi-sector bonds, I would argue that a lot of that existed before anyway. In terms of manager selection and manager structuring, there are different ways to slant in those particular asset classes, you know, the growth exposure overall. So it's not really a substantive change even in kind of the additional flexibility given to staff. It's probably, I would just think of it as more logical grouping of those sectors in one bucket versus rigid separate allocations.
Okay. Well, before I entertain a motion, are there any other questions from trustees? Before I entertain a motion to accept the capital markets and the strategic asset allocation, are there any public comments? There are, in fact, public comments. If we can introduce the commenter.
We have Brad. Brad, you will have 2 minutes. When the timer goes off, you will be muted.
Okay, please go ahead.
Good morning again. Hey, just want to mention, Cynthia, when the trustees are speaking, all it shows is AV Tech 3, so they must be all feeding through one microphone. So it would be helpful for people like me and members of the public, if you identify yourself when you're speaking. And I'm specifically talking about the trustees and staff. Anyway, the Makita report, the most recent one here that was presented, appears to be AI generated. So anyway, I don't want to belabor the issue, but it's good to hear that the board is taking it seriously, and you're going to hopefully dedicate maybe a workshop or something where the public can attend to seriously discuss how AI is going to change the future of the management of our pension funds. Thank you. Have a nice day. Bye.
Okay, any other public comment? There are none. Given that, I will entertain a motion to accept the strategic asset allocation.
I so move.
We have a motion from trustee Abbott. Do we have a second?
I will second.
We have a second from trustee Chandra.
She keeps beating me.
The duo team here, great. Any further trustee comment on the motion? If not, we can vote. All those in favor? All opposed? Motion passes. Thank you. Now we're on to item 5A, oral update from our CEO, Mr. Flynn.
John Flynn, CEO. Good morning, trustees. Want to make you, the board aware, we had an issue with a mailing that went out to retirees earlier this week, encouraging them to enroll in our Member Direct portal. Some letters went out with some font formatting issues that caused text to appear with odd spacing. Information was correct, but we received a number of calls who were understandably concerned, especially with the city's data incident earlier this year. I wanted to make the board aware, because we have received a number of calls. In those calls, we also received a very small number, but a number of members who received more than one letter in an envelope. So while we believe the font issue is something that originated internally, we are investigating the multiple letters in one envelope with our printer, because that's where that issue would have originated. It's an active situation. We received a large number of calls on Monday. When I say large number, we're talking about 20, 25. But it is an active situation, and myself and the senior staff are monitoring that a few times a day. And then once we're also reaching out to talk to our vendor about the quality assurance components of the work that they did and how we can make sure that doesn't happen again. This is a printer we've used a number of times in the past and would have planned to continue to use, but we'll see how this is handled. Earlier this week, I attended PRISM annual conference, PRISM, not prison. PRISM is an organization that brings together IT leaders from public retirement systems to share experiences about emerging technology. As you can imagine, based on earlier comments today, AI adoption across the industry is a major topic of discussion. It's accelerating. My takeaway is that the most mature examples that I'm seeing from organizations are really in their dedicated software development teams. So organizations that have their own IT stack and own development offices are really, that's where they're getting the most bang for their buck currently. What I would say is the most important takeaway for ORS is that governance, policy, and operational implications of AI are becoming significant. The technology itself is something that we need to think about and develop our approach. The city is forward-thinking in this area, but I think it's a good idea that we bring together some thoughts and some discussion at the board level to talk about the current AI governance structure here at the city of San Jose, and then if there are any things that need to be more specific for our role in providing retirement services to our members. We have 2 open recruitments underway. Applications for the information system analyst and benefit analyst postings are closed. We've received hundreds of applications, which is great, and we anticipate that interviews will begin in June as well. We plan to post the deputy CIO position and the benefits program manager's position once the permanent positions are approved by City Council, hopefully in early to mid-June. We have a handful of staff that are higher classing into these open positions across the agency, and I just want to take a moment to thank them for stepping up and supporting the organization as needed. From a governance perspective, April was a productive month. The policy, governance framework, and work plan policy on policies and public comment policies were all approved at last month's meeting. The amended public comment policy, as approved last month, was on the consent calendar today for 1.6.e. Looking ahead to June, Aon and staff are redlining the Board of Administrative Charter, the CEO and CIO performance evaluation policies that we plan to bring to the Joint Governance Committee next month. Staff has also delivered consolidated feedback to Aon on the CEO and CIO charters and board education policies that Aon will use to develop presentations and lead discussions at the June meeting. Lastly, the governance area of our website, we launched the updated website section that is, the site itself is now ADA compliant, as well as all the documents that make up our governance backbone. We are processing contracts for our Boyer Communications contract based on earlier approvals from the board. Our social selinator, social media contract extension is now going through the new ABA 339 process. As reported in April, we met with IFPTE, and they have indicated they will not be objecting. We also met with MEF on April 22nd. They have indicated that they would like to continue the process. We are working through the process with OER towards the end of June deadline. Also, some other minor contracts items worth noting is in today's audit committee meeting, we have a contract amendment that we're going to be bringing for our Baker Tilly contract. A little bit of cleanup on and the organization of the tasks and deliverables associated there. No major changes. We're also working with the city to do a citywide catering RFP that would impact our specialty food vendors for our meetings. We'll be following, we expect that to close on May 19th, and we'll be following up with city finance shortly thereafter. And then lastly, we're continuing to collect certificate of insurances as a new audit process within our contracting. We've received 10 of the 26, and staff are actively following up. Just a reminder for our members who are out there listening, quarterly retirement planning workshops for Tier 1 and Tier 2 members who are approaching their retirement. The next Federated workshop is scheduled for August 13th. At today's audit meeting, well, we'll be working, Baker Tilly will be presenting their risk assessment and 5-year audit plan. 3 prior internal audit recommendations have been proposed closed and validated by Baker Tilly, and they will also come before the committee later this afternoon. If approved, that will leave 7 recommendations open from our outstanding internal audits. In regards to our independent financial audit, you may remember that MGO, as part of their fiscal year 2025 financial audit, made a recommendation based on a finding regarding members of military leave and the lengthy process for reconciling their payroll accounts after they return from their leave, which delayed updates into the ORS system. ORS operations responded quickly to the identification and recommendation from MGO. ORS has updated its standard operating procedure regarding these types of members on military leave, allowing staff to clear exceptions while the member is still on leave before the city completes their reconciliation process. This will now allow our system to remain updated and but will still require final account adjustments after the reconciliation process is complete. Of the 10 identified cases by MGO, we have cleared all through our system, and there are 3 that still are going through the HR reconciliation process, which we will update as part of our standard operating procedure once we receive that back from the city's HR. On the consent agenda calendar today, 1.6.c, the city auditor's status report of 12/31/2025 reports that ORS has no outstanding audit recommendations. We completed that work early last summer, but missed the deadline for the mid-year update, so we're happy to report of the confirmation that all of those items have been closed. Following your approval of the strategic plan in March, I've developed an action plan with strategic initiatives to deliver on the board's approved goals and objectives. I was hoping to bring that to this meeting, but I'm still reviewing internally with senior staff and plan to present that at the June board meeting. I've spent the last couple of months preparing the board for the ADA WCAG new compliance requirements. In the final hours of that, leading up to that deadline, the feds have extended the deadline from April 24, 2026 to now April 26, 2027, giving us another year. Luckily, we had done most of the work required. We have identified a few additional gaps. So this additional time has now allowed us to work through those additional gaps. But staff continue to work on remediation of the website's forms and informational materials, as well as all the attachments that you see on your agenda month to month. The fiscal year 2026 staff climate survey results are in. They were generally stable year over year, with the combined average remaining at 3.9 out of 5.0. As a reminder, this is a survey that we deliver to staff to talk about the climate of ORS and the working conditions, used as an input to the CEO, CIO performance evaluation, but more importantly, used by me and the senior staff to take an assessment and an alternate look at how the staff feels about working at ORS. Comments shifted a little, mostly from structural concerns last year to broader management themes such as consistency and fairness, and clarity and trust in day-to-day supervision. With the board's recent adoption of a consolidated mission, vision, and core values, I plan to make that a focus in our next all-staff meeting, connecting the mission to the work and trying to bring the core values to life at ORS. The Lacera versus the County of Los Angeles case presented oral arguments on May 6th in San Francisco. Myself and Reed Smith, we will continue to monitor the court's decision and update the board as needed. At ORS, we're having slight parking lot construction, not done by us, obviously, but by the building. So for any of our members, that construction should be wrapped up by the end of this week, or scheduled to be wrapped up by the end of this week, but it requires you to walk around the building clockwise from the parking lot versus the direct path. So just know that you'll need some extra steps to get into our office. Lastly, we expect to distribute our member newsletters in July, and just a reminder that in observance of Memorial Day, Monday, May 26th, ORS offices will be closed. With that, I'll take any questions.
That was a lot.
Thank you. Are there any questions from trustees on that lengthy list of objectives and accomplishments?
Just a check off, this Mark Linder, I'm just checking on the first piece you had.
Yep.
About the mailing. Are you anticipating that you want all retirees to complete this and sign up for it and whatever? And is there, if they don't, what's the complication?
Sure.
We have a retiree meeting coming up June 11th, and I'm anticipating I'm going to be asked.
Sure. We will always encourage people to sign up for Member Direct. It allows us to do direct communication with them. It allows them to do direct, secure communication with us. But most importantly, it allows them to take ownership over their Member Direct account versus it being out there waiting for them to be taken ownership of. And so what we're trying to do, because we're, as you're hopefully see in June, or part of our strategic initiatives, we're going to start to roll out some membership self-service as part of a Member Direct. I don't want to get ahead of myself, but the more people we have enrolled, the more people that will be able to take advantage and hopefully get over the nervousness of having an online account with retirement services. So absolutely, they should all sign up for Member Direct account. If they have any questions or any concerns, they should always just call the main number. Our staff is aware of the formatting issues that might give them concern, and of course, if there is a communication that they received that was not directed to them, call the main number. Never have to call the number on the letter or the email that they receive. This way, they can guarantee they're talking to somebody in my office.
And if they never sign up, which some cantankerous
Sure.
retirees.
We will continue to always do business in every way that a member needs us to do business for them. And so while we're going to hopefully be rolling out some self-service components that will allow them to make some of these digital updates online, we will always support the online, the manual forms, allowing them to be mailed to them and to mail to us.
Good. Well, at our next meeting, which is the barbecue one, when we have the big turnout.
There'll be a lot of people there. Yeah. Please share the word.
Helpful. So thank you.
Dangling meat in front of people is a good way to draw them in. Yeah. Any other questions from trustees? And since no action is required on this agenda item, I will take any questions from the public on this agenda item. There is no comment, so thank you very much. Go on to item 5B, which is an oral update from our City Council liaison, and that is Vice Mayor Foley.
Good morning, everyone.
Good morning.
Thank you for interesting meeting today. A couple of things I'd like to report. First, I had a very nice meeting with the chair and vice chair yesterday, a quarterly meeting. It's good to get updated and make sure that there's anything that I can do to assist or vice versa. Have that open line of communication was helpful. We are in the middle of the budget adoption period. The city manager did deliver to us a balanced budget, which is required, which means that she, through the budget director, found a way to balance the $50 million deficit that we had. This did not come on the backs of our employees. We did not lay off a number of employees. We actually maintained our employee list for quite a number of our employees. There were a reduction in positions, but there are not people who fill those positions. There are a few actual layoffs, but very small in relation to an overall 7,000 member team. I think it's 12 to 18. I frankly, sorry, I forget the exact number. There's budget documents due today by the City Council wherein we ask the mayor to fund certain projects either in our district or within the city that are important to us. That's submitted based on a $2 million pot that is included in what's called essential services. It's not guaranteed that each council member gets 200,000 of that. That's really up to the mayor to decide how those funds will be allocated. I like to use my request to fund things like traffic improvement and subsidize those with my own traffic funds within the city. So hopefully he'll approve all of my requests, but I won't know until the budget comes out whether he thought they were all a good idea or not. So the next step is we're moving along. The next step is that the mayor will take all the budget requests. He'll take the request from some council members to change some of the funding or eliminations in the budget that were created by the city manager and add back in funding. To do that, the council member must find an offsetting expense that is being cut or a program that might be cut. So we'll see what happens there. The June 1st is when the mayor submits the budget. June 8th, there is a public hearing in the evening that is pretty much a well-attended meeting because that's the opportunity of the public to weigh in on the budget before we actually adopt it the next day. As of June 1st, or not as of, on July 1st, we are required by state law to allow public comment virtually, and we will be going to hybrid meetings. But on June 1st at the council meeting, we will discuss a policy to begin hybrid meetings as of June 8th so that we can have a public hearing on June 8th. I expect council will adopt that, but I haven't seen the proposal yet. That doesn't necessarily apply to all of our committees or our commissions. It does apply to the city committees. It does not necessarily apply to the commissions. Of course, you've made your own decision. You're independent of the decision that the council has made. We are currently in the middle of labor negotiations. A couple of our bargaining units look like they're close to settling with us. A couple looks like we're not that close. And I will leave it at that and take any questions that you may have.
Thank you, Vice Mayor. Any questions from trustees? Any comments? Okay, again, action is not required, and we have no comment from the public, so thank you very much for the update.
Thanks.
Busy time.
Yes. Moving forward to 5C, I think we can, I'm not going to take a break at 10 o'clock because I think we can actually clear the agenda by shortly after. 5C, discussion action regarding Federated Tier 1 and Tier 2 contribution rates.
I'll introduce this.
Okay.
So this is the annual set of resolutions to set contribution rates for Tier 1 and Tier 2. This is the culmination of all the actuarial work that has been done to date, as well as working with the city to finalize their decision around pre-funding or alternate funding throughout the year. And so this is the last step in the process so that we can work with the city to set the rates. There's a number of different rates. We show the year-over-year changes, fairly performative based on all the work that has been done.
Okay, thank you. Nice to see decreases in all the categories, however slight. Any questions or comments from trustees? Any public comment on this particular agenda item? There is none. If not, then I'll entertain a motion to accept these contribution rates as proposed. Anyone?
So moved, Mr. Chair.
Thank you. That's a motion from trustee Linder. Is there a second?
I'll second.
Okay, that's trustee Nakagawa on the second. Any further discussion on the motion? Seeing none, all those in favor, say aye. Aye. It's accepted unanimously. Great. 5D, discussion action on trustee education survey results and staff's proposed board education plan. How are we going to get smarter?
Give me 1 second so I can share my screen. Okay, as you all know, we sent out, we requested a survey of board education related topics. The input on the selection of the topics was an input from myself, from our new CIO, Reed Smith, Aon, and our actuary, Bill Hallmark, to create the list of 17 educational topics that we asked you to rate on a scale from 1 to 5. We received across both boards 15 trustee responses, as well as input from 3 staff, myself, Barbara, and Jay. You can see the results weighted from top to bottom on each of the educational topics. It's a bar chart that gives us the relative weighting across all of those surveyed. The bars that are in the dark color are the topics that we are going to recommend including in 4 educational topics throughout the next fiscal year. So we combined a few of the topics together where they made sense. First session is on actuarial literacy, talking about the assumptions and their impact. We're talking about developing a formal funding and amortization policy for the funds. These are embedded in the actuarial reports each year, but we thought it would be prudent and best practice to have a standalone policy. So that's one session. We typically do an actuarial topic leading into actuarial season. So we'll work. We categorize that as our first session. Trustee roles and responsibility. What we heard from the trustees, both in the rating but also in some of the comments, is that they want a better understanding of the board versus the staff role. The board versus operational authority of the administration, and governance boundaries, kind of getting a lay of the land of how trustees operate with staff and where the lines of responsibilities are drawn. For session 3, we're talking about fiduciary duties and conflicts of interest, working through the prudent person standard. We often get one-off questions around conflicts of interest, also relating to disclosures and recusals. So we thought this would be a good topic to bring to both boards and for all trustees to participate in. And then lastly, especially in the comments, we saw a real desire to talk a little bit more about risk management and specifically in the board's role for oversight of data and vendor risks, and also including our incident responses in terms of disaster recovery or business continuity. What would the board's roles be in events such as that? So these are the 4 proposed topics. We're asking for your approval so that we can move forward in working with our professional colleagues in the different areas to bring these to you in more of a short form format that would be included during board meetings rather than like last year where we did the full day retreat, maybe in every other year where we do a full day retreat versus focusing on the shorter form education.
Okay, thank you. Any questions from trustees? Any plans to in future, there was a whole bunch of other ones that fell below the top four that didn't make the ZBB line, so,
I would anticipate, very similar to what we just did, put out a new set of topics next year based on
I see.
whatever the current environment is, the current questions that we're receiving, get another set of survey responses, and then come to you again, almost as a plan for the following year.
okay. And these sessions, these are 4 separate trainings, they would be spread over 4 different board meetings?
Yes.
Okay.
Yes.
So we cannot
I, you know,
pack it all together.
trying to focus on meetings where we don't have heavy investment quarterly performance reports, or if we're doing a heavy actuarial meeting, you know, a meeting like today would be a perfect example of where we would try to slot one of these in.
Right, right. Any other trustee questions? Is there any public comment on this agenda item? There's no comment, so,
I was just gonna make a
okay.
comment. But this looks really well organized and well thought out, and I like the idea of doing it over 4 sessions, you know, within the scope of what we're already planning to do in a board meeting, so, really good idea. I was also wondering, since we've been talking about AI, when we might, you know, put that in, since that's an important sort of operations and investment kind of a topic.
I
think, sorry, I reached out to John yesterday, and I think Jay 2 days ago, and I sent a note to Spencer. I think we need to have a board, there needs to be a presentation done, that's gonna be my request for agenda item,
Yeah.
is not diving into something substantive like that in an education plan. We have to have a policy first.
Yeah.
And so I think having the staff report out what the city's policy is, what we are doing. I asked Jay and the staff, we had a call as to how they're using AI, the kind of tools that they're looking into. I think we have to start there. Educate, it would be too going into the trees, and I think we need to focus on the forest
I agree.
To that end, does the city already have an AI policy?
They do.
Yes,
they
So
do.
it's been established, okay.
Yeah.
Okay. Any other comments or insights? I certainly agree we need to look at AI, but it's, looking at AI is looking at water. I mean, there are many different aspects of it.
Yes.
That require its own separate discussion item. With that, I'll entertain a motion to accept this education plan.
So moved.
We have a
Trustee
motion
Chandra?
from trustee Chandra. Is there a second?
I second.
We have a second from trustee Abbott. Any further discussion? All those in favor, say aye.
Aye.
It is approved unanimously. Very good. Okay, on to committees. Item 6.1, Investment Committee. Oral update from the IC Chair, Mr. Chandra.
Yeah, we essentially, we got a public markets report as well, if I remember correctly, but other than that, most of what we covered was covered here today.
Okay, so we will accept the minutes.
Yes,
Audit Risk Committee, we last met way back in February, so I'm not sure there's anything new to report. Mr. Linder?
Nothing new, except that we always like good news about no reportable incidents in the audit reports. So.
No news is good news in this category
But
for sure.
we are meeting today. We'll have a nice hour and a half time
Yeah.
to prepare. But we'll be meeting at noon today.
Okay, this is a long interlude, yes. Okay, very good. Governance Committee, Trustee Abbott, Chair of the Governance Committee.
Yeah, we have no new news, but we will meet again in June, so.
Very good. And Disability Committee, Vice Chair Faulkner, Chair of Disability.
No meeting since February. Our next one will be in June.
Okay, moving right along. JPC, Chair Chandra.
Oh, no, at the April 1st meeting, I was demoted to vice chair
Oh.
of the Joint Personnel Committee.
Very sorry to hear that.
Yeah.
Rotation system.
The rotation is in full effect. Yeah, so we are just reviewing some of our peer benchmarks for investment staff compensation below the CIO level, and so that work has begun.
Okay. And I believe we even have a draft report from an outside consultant.
I didn't see it.
Oh, is that right?
No, I
Okay.
believe you. I just.
Okay.
Yeah,
I
so
think we do.
Okay,
Okay.
we'll get it to you.
Thanks.
Okay, education and training, a variety of things. I see, I noticed that some are attending a CalPERS trustee online event. What is the topic of that that's coming later this month? Does anybody know?
The topic is discussion.
Discussion, okay, so generic.
Of
Round
things that
table.
may be of interest to us.
Okay, often they have a specific topic area, it sounds like not. Okay, and we do have a couple of folks heading down to Santa Barbara for the principals, so that'll be great. Proposed agenda items. I believe we did hear one from trustee Chandra. Any other proposed agenda items? I guess I should also ask if there were any public comment on all those committee reports and education and training, seeing none, and hearing no proposed agenda items. At 10:05, we are adjourned.
Recording stopped.